prefer things that are familiar to them. They root for the local sports teams. They like to own stock in companies they work for. Their sports teams and employers are familiar to them. The average investors will more likely buy into cryptocurrency developed by people within their country and continent at large. I'm Mr. Melvin Emeka from Abia State, and today I'll be explaining the role of familiarity in our day-to-day investment decisions. When you are faced with two risky choices, one of which you have some knowledge about and the other of which you have none, you choose the one you know something about. Given two different gambles where the odds of winning are the same, you pick the gamble that you have more experience with. In fact, you will sometimes pick the more familiar gamble even if its odds of winning are lower. With all these facts I've stated, very few people will argue against the statement, familiarity breeds investment. Today, there are hundreds of thousands of potential investments in the stock market, the real estate market, and even the foreign exchange market. There are also that many choices in the cryptocurrency market. So, how do investors choose? Does everyone analyze the expected return and risk of each investment? No. Most people trade in the securities with which they are familiar. As a matter of fact, you are most likely among those who trade in securities with which you are more familiar. Honestly, there is comfort in having your money invested in a business that is visible to you. As an example, let's consider the breakup of AT&T. In 1984, the government broke up AT&T's local phone service monopoly into 7 regional phone companies known as the Baby Bells. 12 years after the breakup, who owns these Baby Bells? It turns out that investors are more likely to own shares in their local phone company than the phone company of another region. They are more comfortable investing in the more familiar company. The inclination to invest in the familiar causes you to invest far more money inside the borders of your own country than traditional ideas of diversification would recommend. In short, you have a home bias because assets from your own country are more familiar to you than foreign assets. Let's use a real-life example for instance. The stock market in the United States represents 47.8% of the value of all stocks worldwide. The stock market in Japan and the United Kingdom represents 26.5% and 13.8% respectively of the worldwide stock market. Therefore, to fully diversify a stock portfolio, you should allocate 47% of your portfolio to US stocks, 26.5% to Japanese stocks, and 13.8% to UK stocks. In fact, modern portfolio theory suggests that all investors should have this allocation. But do investors use this allocation? The answer is a resounding no. The stock portfolio of US investors are 93% invested in US stocks, instead of the 47% suggested by portfolio theory. Japanese investors are 98% invested in Japanese stocks. UK investors have 82% of their stock portfolios in UK stocks. Investors purchase assets that are familiar to them, and people are simply less familiar with foreign assets. People invest some, but not much of their money in foreign assets. What types of foreign assets would you buy? Those that are familiar to you. The foreign companies that are most familiar are the large corporations with recognizable products. For example, non-Japanese investors tend to own shares in the large Japanese companies. The smaller Japanese firms that attract non-Japanese investors have high levels of exportation. Investors choose stocks that are familiar to them in both domestic and foreign markets. Americans pick familiar foreign firms, but they bias their portfolios towards US companies. They also tilt their portfolios towards local firms. For example, Coca-Cola's headquarters is located in Atlanta, Georgia. Investors living in Georgia own 16% of Coke, and most of these investors live in Atlanta. Coke sells its products worldwide, but the people most familiar with the company own the largest percentage of it. Professional money managers also invest in the familiar. Even though US professional investors have access to fast information sources and analysis tools, they still tilt their portfolios towards local firms. This is especially true for small local firms and riskier firms. On average, the company stocks that a professional money manager buys are headquartered 100 miles closer to the manager's office than the typical US company. Now, we are both aware that in most cases, any beneficial entity comes with its fair share of problems. In the same way, just as familiarity breeds investment, which is a good thing, familiarity also breeds investment problems. What company are you most familiar with? Generally, you are most familiar with the company you work for. This familiarity causes employees to invest their pension money into the company stock. For example, the 401k pension plans of most companies allow employees to invest money in options like a diversified stock fund, a bond fund, and money market instruments. One common option is the company stock. Modern portfolio theory suggests that employees diversify their retirement assets, selecting diversified stock, bond, and money market funds as needed according to their risk tolerance. When an employee selects the stock of one company, usually the company he's working for, that is not diversification. Considering the fact that that person already has his labor capital tied up to the company, to fully diversify, it's only smart that the person should avoid investing their financial capital as well. If your job and your retirement assets depend on one company, you could be in for a very huge shock. Consider the plight of the employees of Color Tile, a Fort Worth, Texas home decoration retailer. When the company declared bankruptcy, many of the 1,362 pension plan participants lost both their jobs and much of their retirement money, as their $20 million pension plan was heavily invested in the company stock. The stock of companies declaring bankruptcy frequently becomes nearly worthless in bankruptcy court. Even large established companies can go bankrupt. For example, on April 6, 2001, Pacific Gas and Electric, California's largest utility company, filed for bankruptcy. You should also consider the fact that your company doesn't have to go bankrupt for you to be adversely affected. Several employees of Miller Brewing Company were going to retire early. Philip Morris owns Miller. Unfortunately, these employees ended up losing most of their 401k investments in Philip Morris's stock. Near the end of 1998, Philip Morris's stock peaked at $56 a share. But by the end of 1999, the stock had fallen to $23 per share. If these employees had been planning to retire on a nest egg of $500,000, that egg would have been shrunk to nearly $200,000. This 59% loss occurred during a time when the general stock market, that's the S&P 500 index, advanced by 26%. Now, what are the consequences for these employees? Early retirement will probably not be an option. Fortunately, Philip Morris began a partial rebound in 2000. That's Philip Morris' stock. It began a partial rebound in 2000. By year end, the stock had risen to $44 per share. Just how common is it for employees to invest their retirement money in their company stock? In a survey of 246 of America's largest companies, 42% of the total 401k pension plan funds were invested in the company stock. Employees themselves make these decisions. They like investing in the company stock because it is familiar. When you are familiar with something, you have a distorted perception of it. Fans of a sports team think their team has a higher chance of winning than those who are not fans of the team. Investors look favorably on investments they are familiar with. They believe that familiar investments will deliver higher returns and that they have less risk than non-familiar investments. For example, the Asians believe that by next year, Binance Coin, the leading cryptocurrency of their continent, will perform better than Ethereum, the leading cryptocurrency of the European continent. Meanwhile, the Europeans believe their leading coin will perform better. The average citizens believe that a cryptocurrency developed by their countrymen is a safer investment than a diversified cryptocurrency portfolio. The brain often uses the familiarity shortcut to evaluate investments. This can cause you to invest too much money in cryptocurrencies that are most familiar to you, just like the unfortunate Nigerians who invested in Zuka coin that year because of it was their pastor that created the coin. Let's not talk about that one. Ultimately, all these familiarity issues lead to under diversification. You don't diversify your investments enough. You allocate too much of your wealth to your employer, local assets, and domestic stocks. And as a result of that, your mind, your finances are not open to better opportunities that exist in further places. The whole point of this video is for you to understand that in as much as it is good to invest in businesses that are more visible to you, you should keep in mind that the fact that a business, an investment, an asset is more visible to you, the fact that it is closer to you does not mean that it is a better option than that one that is further. You should always learn to evaluate objectively. Look at the numbers. Look at the stats. Employ the services of a professional. It is always better to do that than to just play the familiarity card and go ahead anyway. Thanks for watching.